flat price will rise with geopolitical tensions. Fundamentally, a lot of players actually said the market was bearish, and I think if there was no such spark of US involvement in the Iran attacks, the flat price would have likely been quite low in the 60s, even the low 70s maybe. But with this attack, everything kind of changed. It really did indicate that US is making a statement. We are supporting Israel in this war. In these hostilities. What are the risks that we are looking at is all the potential infrastructure impact to oil, both on the crude and refined product side, as well as the supply chain for the logistics to flow to the different refining and demand hubs. The market was going to be like around the 80s level, which I think it temporarily did hit that number, but it's sort of muted again. Probably an indication that there is an expectation that it's not going to be a very strong scenario of the Straits of Hormuz itself being closed. There is a lot of implications to Iran if they decide to close the Straits of Hormuz. They depend on it for their own livelihood, for their own provisions, and also for the export of their oil. So it is akin to shooting themselves on the foot. Any kind of closure as well would be very likely short-lived. Thus, the market is probably viewing this as a very tail-end risk still. The possibility has, of course, risen with a potential Iran being needing to show their retaliation against the US. However, the market is not seeing that as a very strong signal right now, given where flat price is. We saw about $10 per barrel jump from the time this hostility started around the 13th of June. And of course, market has been very backwardated since then. Time spreads, Brent spreads are now close to $2 per barrel. Prior to this, I believe it was sub $1 per barrel. Another key thing that has happened is the products east-west spreads. We have seen gas oil and jet east-west spreads widen significantly in favor of the west, and this is an indication of where the risk of potential Straits of Hormuz closure will be, because a lot of this oil is being sourced from Middle East up to the demand hub of Europe. Without this oil or any curtailment of this supply chain would indeed cause a shortfall of such barrels, middle distillate barrels into the key hub of Europe. Naphtha East-West has also widened in favor now of Asia, of the West, of East, because the Eastern market is a strong demand center for naphtha for petchem. And the petrochemicals market will need that pool of naphtha, which we've normally received a lot from Middle East refining hub. The Middle East is one of the biggest supplier of oil. The US, most people look at the US, can you step in and produce more with this potential shortfall? Maybe they are a big oil supply hub. However, the quality of oil might not be what the market needs to replace it with. The crude from US is light sweet. The Middle East barrels for crude are mainly medium sour. Refineries cannot switch that easily between these two grades. and therefore the shortfall of this medium sour quality crude will affect the way the refineries will produce the oil. We need to monitor how Iran retaliates, or when and if they retaliate. It might be a short one, like a closure of the Strait of Hormuz, but that will be very short term in our opinion. If they decide not to do that and just have the threat of it, which is already giving a lot of shippers a very, very nervous situation, they might not even take the risk of going there. That is already enough to also create that fear in the market, which is probably what Iran also wants. That will be a prolonged situation. So Iran might be playing the short game or the long game, and we need to see how that comes out into the market. Asian refiners will bear the brunt of this saga, because we are the Asian refineries here have a lot of exposure to the Middle Eastern crudes. We are all configured for that kind of feed, as well as just the current supply chains favor this route. So in the event that this is going to continue, the competitiveness of the Asian refineries will reduce compared to the Western refineries. We already see that in the gas oil crack. The gas oil crack in the East has not risen as strongly as the Western refiners, because the Western refiners will basically enjoy strong refining margins as well as less risk to the crude supply that they will be facing. So my take is really there is the East and West divergence in terms of refining feeds, and right now Asian refineries are really bearing the brunt of it.